Hello and welcome to another 30-minute Thursday. My name is Amit. It is 2 p.m. in the, can't tell if it's spring or winter, Pacific Northwest, and we are live on Facebook. Welcome everyone. I hope you guys are doing well. I hope everyone's staying healthy, staying safe, staying sane. Very important to stay sane in an otherwise insane world. We are live on Facebook. At least that's what I am led to believe by my technological setup. And I think that we're getting better at this because it's actually coming together. There's no feedback. There's no what have you. Now, it does take a little bit of time for the video to load onto Facebook because I'm doing things on Zoom platform as well. So bear with me. I know, but we're doing okay. And here we are. So as I posted earlier today in promoting this Facebook, the Federal Reserve Board continues to raise interest rates. Yesterday at their meeting at their monthly meeting, or they meet every 6 weeks, but at their meeting yesterday, they announced that they are raising short-term interest rates by another 0.25%. So now the federal funds rate over the course of 1 year, when they started raising rates in March of 2022, they have gone from zero, basically, which is where we were coming out of the COVID pandemic. They've gone from 0 to 5% roughly on their rates in 1 year. Unprecedented. It is a huge increase, and it's a fast increase. It would be the equivalent of doing 150 miles an hour and slamming on the brakes as hard as possible, or slamming into a wall head on. It's going to cause damage. Someone's going to get ejected from the car if you do something like that. And this is what the Fed is doing right now. And in doing that, they're trying, or they're claiming that they want to combat inflation, which is a noble and important function that the Fed serves. It's actually their second most important role. Anybody have any guess as to what the number one role of the Fed is? The first thing that they were designed and intended to do? You guys are going to love it. It's going to make you laugh. If you don't laugh in this crazy world, you're destined to cry. So I choose laughter every time. But the Fed's number one goal is to prevent a run on banks. That's right. That's historically more than 110 years ago. The Fed was founded in the year 1913. The Federal Reserve Board was founded to prevent runs on banks and to stabilize the banking sector. And that was their primary goal. And somewhere along the line, and I apologize, I don't know exactly when they had a kind of additional mission assigned to them, or they took on the additional work, or whatever it is. Let me expand my screen here just so there we go. Somewhere along the lines, they took on the added responsibility of maintaining inflation at a rate of 2% year over year. Why 2%? I don't know. They don't even know. No one will tell you the story behind that, because nobody really knows the story behind that. But what we do know is that the Fed's number one rule, or number one role, I should say, is be here to prevent a run on the banking system. What does a run on the banking system look like? What is that exactly? Well, amazing. We're seeing it happen in real time. And I'm having conversations with people in real time about this. I actually have, yes, a newspaper. Check it out. I mean, this is old school print media. If you'll notice, the name here is First Republic Bank. This is a bank that is teetering on the brink right now of going under. And the reason they're teetering on the brink of going under is because depositors are pulling their money out of the bank at record pace. And why are they doing that? Sorry, guys, I'm just trying to catch a decent angle here with the sun. It's gray out there, but it's still bright gray. We got a lot of definitions of gray for the sky here in Seattle. But what's going on with First Republic Bank? It's one of the ones that's on watch list. There's about 200 others that are facing similar problems right now as well. And the problem is that when there's a loss of confidence in a bank by the people who deposit money in that bank, that would be the customers, when we feel like, oh man, they are going to go under and we're worried about our money being safe, what happens is people run to the bank and say, give me my money back. And that's what a run on the bank is. And why that's a real problem is because the bank only keeps, typically, bear with me, take it with a grain of salt, but typically they keep 10% of the funds on deposit they keep in their bank. So I said it last week, I'll say it again. If you've got $1 billion on deposit in your bank, roughly $100 million is available cash. The rest of it is being lent out. The rest of it is in the economy doing what money is supposed to do. Help people buy cars, help people pay, use credit cards, help people buy homes, do business loans and things of that nature. That's what modern banking looks like. And it's been this way for many, many decades, if not centuries. And so to prevent this from happening, the US government chartered and created the Federal Reserve Board and the Federal Reserve System in 1913, so about 110 years ago, in order to backstop the banking system. So if there was a run on the bank and people, running down to the bank, say, give me my money back, the bank could call up the Fed and say, hey, I've got $1 billion on deposit. I've only got $100 million in my current holdings, and I've got every one of my depositors clamoring at the door, asking for their money back. I need a short-term loan until we could stabilize the situation. And that's what the Fed was originally designed to do and empowered to do. And I find the irony of this is remarkable, because in the course of the Fed's efforts to contain the growth of inflation, which we are all suffering from in one form or another, in their zeal to do that, they are causing runs on banks. And that's what we're seeing, not just at, First Republic Bank, not just First Republic Bank, but a lot of other banks. We saw Silicon Valley Bank go under. We saw Signature Bank going under. We saw Credit Suisse go under. There are about 200 or so banks that are at risk because of this. And 200 is a nice, easy round number. I don't know. I don't know that anybody really knows. We'll find out if and when they implode, and then we'll have a huge mess to clean up. But it's a mess, sadly, that is being caused by the Fed itself, which is crazy. Talk about throwing the baby out with the bathwater. But the reason that they're doing this, again, is because they took on the second mandate, which is to keep inflation at a 2% growth year over year, meaning things appreciate in price 2% from one year to the next. And they totally blew that last year, and we hit like 9% inflation, and so the Fed freaked out and hit the brakes as fast as they could and as hard as they could. And someone's going to get thrown out of the car, and these banks are among the casualties right now, as is potentially our entire economic system at the moment, because it's a pretty big problem. And notice that First Republic Bank, this is really amazing. They're offering 4.9% AP average percentage yield, or average percentage interest, for opening a CD with them, because they're trying to get money back in. This is what happens when depositors wake up to the reality that it's not First Republic that's being managed badly or not managed badly. I don't know. I haven't audited their books. I don't know what their executive people are doing or not doing. It's not for me to say that they're doing the right thing or the wrong thing. We'll find out as well eventually. But what is causing all this is that the smart investors, the people who are aware of what's going on, realize that, like, I can take my money out of the bank and put it into a different investment, and it's going to be relatively secure. It's going to be backed by the US government, which typically is a relatively secure investment. And I can get like a really good interest rate on that. Like 4.9% is nothing to sneeze at for something that's insured by the FDIC. It's pretty much guaranteed money. So if you gave these guys $100,000, after a year, you'd have $104,900. That's not bad for zero risk. Now, your money's going to be tied up for the year and you can't necessarily extract it to do something else with it without suffering some kind of loss of interest or whatever it is. But still, that's a pretty good return. And the problem is for these banks is that they have to do this. They have to raise what they're offering to investors like me and like you and like my father-in-law who gave me this newspaper. Yes, I'm analog, but I'm not this analog. I do not do newspapers anymore. But my father-in-law is looking for a place to put his money also. And a lot of people are. And so he's asking me, hey, is this a good deal? And I said, well, it's interesting because the bank itself is on the ropes, man. They're teetering on the brink. But the FDIC, the Federal Depositors Insurance Corporation, is going to protect up to 250,000 of your dollars in this bank. So if you buy a CD with that, a certificate of deposit, you're basically safe. I don't know what happens mechanically speaking if you hold a CD in this bank, and I'm not picking on them in particular, except for the fact that I just happen to have this in front of me. I don't know what happens if you buy a CD in a bank and then, held by a bank, and then 3 weeks later or 2 months later, the bank fails. Like, how do you get your money back through the FDIC? I don't know. Knock on wood. Thankfully, I've never experienced that kind of mess. But the mess itself, the big picture mess, is when the Federal Reserve Board shot interest rates up like this, 5% over the course of a year. It's unprecedented. When they did that, they created this huge imbalance in the banking world because banks like First Republic and a bunch of these other banks, they were sitting on a lot of deposit money from the year 2020 and 2021. So let's go back the Wayback Machine here, a couple of years, 3 years, and let's talk about what happened here. When we had all the stimulus money coming out of the government and hitting everybody's accounts or mailboxes or whatever it is, there wasn't a lot of stuff that you can buy. There were no trips to take, right? There's no at least in 2020 when the whole world was shut down. So a lot of people put that money in the bank, and the bank has to do something with that money, right? They have to put that money to work. Now, they're paying you, or were paying you at the time, a really tiny 0.01% interest. So they were paying a little bit of interest, but they still had to do something with that money. They're not sitting, it's not Fort Knox. They're not sitting on a pile of cash that was deposited. And so they did at the time what they thought was the smart and safe and sensible thing with that money. They took all that money and they went out and they bought US Treasury notes and they bought mortgage-backed securities. And so these are longer maturity IOUs. IOUs from Uncle Sam, from the US government, and IOUs from people who I help buy and refinance homes. Right. And so these are 7-year notes, they're 10-year notes, they're 30-year notes, like your 30-year fixed rate mortgage. That's an IOU over 30 years. Right. So they went out and they bought or invested in these very secure, very safe sort of IOUs, but they had really long maturities. And they were paying a rate of interest of like 3%. But keep in mind, the bank had nothing else to do with the money. And I'm not, by the way, I'm not absolving any banks of any responsibility for mismanagement or malfeasance or anything like that. I'm just giving you like the big picture on how we got here. They needed to do something with their money. They bought what they thought at the time was a very stable, very safe, very secure investment in these IOUs, and they parked the money there. And so they're getting 3% interest on that money, and they're paying us 0.1% interest. And so the spread, the difference between those two rates of interest, pretty good for the bank, right? They're making money. We can argue whether or not the banks should be for profit. That's another story altogether, but they're making money. And along comes 2022. And now the Federal Reserve Board is telling us in no uncertain terms, hey, inflation is way out of control. We're supposed to keep it at 2%. It's at 8%. We totally dropped the ball on this. So we're going to have to raise interest rates, short-term interest rates, the stuff that the Fed can control. Remember, I said that their first job was to be the backstop for the bank. So if everyone went running to the bank to get their money out, the bank could borrow money from the Fed to protect the bank from going under. Well, that money was being lent out by the Fed in the year 2020 and 2021 at 0% interest, basically free money. Then in 2022, they started saying, hey, we can't be giving y'all free money anymore. We're going to jack up those interest rates. And they did. They went from zero to 5, right, in 1 year. And in doing that, everybody outside of the banking system that had money in the banking system started looking around saying, wow, I can take my money out of, in this case, First Republic, or out of Silicon Valley Bank, or out of any number of other banking institutions that are struggling. I can take my money out of there and I can buy government IOUs or something else that's really safe and really sturdy, and I can make 5% interest on my money. I could get the same kind of deal that that is out there. That's a much better deal than leaving my money at whatever bank and getting 0.1% interest. And so a lot of people have been doing that. And the rate at which the deposits are leaving these banks is causing the banks a problem. They have a real problem here, because again, they only keep 10% of all that deposit money on hand. The rest of it is invested in stuff that they bought in many cases in 2020 and 2021 at 3% interest. So you see right off the bat, now they have to hold that 3% interest for years. So they can't convert it into ready cash. And this is the problem that the banks are having. So they have to go to the Fed, or they have to go to the FDIC, and they have to say, hey, we need some real help here, because all of our deposits are leaving. We don't have the money to cover the demand on what has been deposited in our banks, and it's going to take us under. And so this is what's going on back and forth now. And we have the Treasury Secretary saying yesterday or the day before, we're going to backstop all deposits, meaning that we're going to guarantee everything. We're going to insure everything for a certain period of time. And then they come out and say, on second thought, no, we're not going to do that. And this back and forth, it's terrible. It's really, really bad for the banks. It's really, really bad for the depositors and the investors, because nobody knows what's actually going on. And the last thing anyone wants is to lose their money. Rightfully so. I don't want to lose my money. I'm sure you guys out there don't want to lose your money either. So how are we supposed to feel good about this, other than to go to these banks that may be smaller, that may be weaker, that we're afraid are going to collapse, take all of our money out and put them in these gigantic banks like Wells Fargo or Bank of America, the ones that in the 2008 financial crisis, the government decided these institutions are too big to fail. And so they're going to be protected no matter what. Maybe I should take my money over there and eliminate all of my risk and eliminate the thing that's going on in my head saying, oh my gosh, what happens if my smaller community bank goes under? Where's my money? Am I going to be okay? And this is what we call a self-fulfilling prophecy, right? Everything's good as long as everybody agrees that everything's good. The minute people start to think, oh man, things are not good, when enough people think that, they will go out and make it not good. And they will run on the bank and they will drag that institution down. And then other people will say, oh, if that institution went down, what about my institution? I got to get my stuff out of there right away, because I don't want to lose my money. And this is what's happening right now. In the face of all this, the Federal Reserve Board decided yesterday that they were going to raise interest rates by another 1/4%. So now we are roughly at 5% interest on the Fed funds rate. That's what they charge banks for overnight lending, for really short-term loans, in case they need to stabilize all the money that's running out of their banks. That's a really expensive rate of interest, which is why First Republic is saying, hey, we'll give you 4.9%. We'll give you a really good rate of interest, cheaper than what the Fed's charging, but you have to keep your money here. If you read the fine print somewhere down here, you have to keep it there for 12 to 15 months, because they need the money. They just need the money to sit and calm down. And that's what's not happening right now. And what's really concerning is that the Fed is the one that's like, the Fed and the Treasury, These are supposed to be the adults in the room. They're supposed to be the professionals and the experts, and they're freaking everybody out. And so we're not really sure where we go from here. But what will happen is there's going to be another meeting at the Fed. Like I said, they meet every 6 weeks. So there will not be a meeting in April if my calendar up here is correct, but there will be a meeting in early May. And they said straight up, hey, look, inflation remains a huge problem. This is our number one concern. We're going to keep tightening, meaning we're going to keep raising interest rates until we have inflation under control. Unfortunately, in order to do that, the byproduct of raising interest rates means that they do want to trigger a recession. They do. I mean, that's exactly what happens. You either have a contraction or you have a recession. You guys may have heard the expression, you're either growing or you're dying, right? There's no standing still. You either have expansion of the economy or contraction. Contraction's a recession. That's what they want. In a recession, you're also going to see layoffs, more unemployment. And we're seeing that. Amazon announced more layoffs. Walmart is laying people off at their fulfillment centers. I read earlier, and I haven't had the time to test it and see for sure, but I saw that some of these online recruiting companies are laying people off, which is really interesting because, you know, if no one's hiring, no one's hiring. So of course the recruiters are taking a back seat to this as well. Someone asked me last time, what does all this mean to mortgages and to real estate? What I can tell you right now in general is that as things tighten, as money becomes more expensive from the Federal Reserve Board, as there's concern that banks are going to shut down or that they've got to do other things to shore up their balance sheets, the one thing that I'm fairly confident will happen in some capacity or another is what we refer to as a reduction of credit risk, meaning that if you have loans out there like adjustable rate mortgages or home equity lines of credit or other mortgages specifically that are designed like zero down payment or low down payment or other things that are pretty wonderful loans in an expanding environment where everyone's good, everyone's making money, everyone's doing things. If you have these loans in a contracting environment, more likely than not, the banks that are making those loans or the lenders that are making those loans are going to say, you know, maybe we don't want to take this much risk right now. Maybe we need to tighten our requirements. Maybe we need higher credit scores on some of these loan programs. Maybe we need larger down payments on some of these purchase loan applications so that we've got a little bit more security here. Maybe we need to do some other things just to make sure that when we do make loans to people, the people receiving that money are in good shape financially, right? We've been doing a great job as an industry since the 2008 collapse. It took some time to clean up all that mess. I'm not going to say it happened instantaneously. It did not. But since all of this legislation was put in place, maybe it was 2013, 2014, maybe even 2015, I don't remember exactly, but we've been underwriting very, very well. So the default risk and the foreclosure stuff right now is relatively minimal, and that's great. But what happens when people start losing their jobs, heaven forbid? And that's what the Fed is saying that they need to do in order to bring inflation down. There's a lot of stuff going on right now, and we're not 100% sure of what's going on. So when institutions, when lending institutions and the people at those institutions who make these decisions are confronted with uncertainty and risk and concern, more times than not, they say, let's pull back. Let's not be as aggressive with the offers that we're making to people for various loan programs. Let's be super conservative. Let's make sure that we're okay in our own house with our own lines of credit, in our own loans, and our own things like that, so that we're not exposed to systemic risk either. Because really what happens in lending, let me check my time. Okay, we got about 5 minutes. So let me go back to what happens in lending, the life cycle of the mortgage as an example, right? You want to buy a house, you come to me, I make that loan available to you through my company, New American Funding, and you get the money that you need to buy the house. That money goes to the seller, you get the keys, you move in, you're making payments, you're good, everything's great. we have in our hands, as a result of you making the loan, we have your IOU, right? And we take that IOU and we sell it, and we sell it for more than what the IOU is. Let's say your IOU is $500,000. We're going to sell it for more than 500,000, and we're going to use that money to pay my salary, to pay the overhead for our office, and a variety of other things. That's the way the business works. And the money that we lent you when we closed your transaction didn't come from our company's bank account. Although my company has a ton of cash, which is great, the way it usually works in all mortgage lending is it comes from other lenders known as warehouse lines of credit. These are commercial lenders. You and I don't have access to them as individuals, but they're massive, and they do tens of billions of dollars worth of loans to companies like mine. And they do it for a very short period of time, 45 days, 60 days, something like that. So during that time, we have to package up your IOU, sell it to Fannie Mae, Freddie Mac, the FHA, the VA, whoever it is, get our money back and pay off our warehouse line of credit. And then we do it all over again. You know, that old shampoo, lather, rinse, repeat. That's how money flows in the mortgage world. And the buyers, the homeowners, you guys, for your part, you're out of that loop, right? You just keep making your payments and everything's good on your end. But upstream from our warehouse lines of credit, if they get nervous, if they're worried about liquidity, if they're worried about our ability to sell that paper to Fannie Mae or Freddie Mac and be able to get the money back to pay them back, maybe they're going to say, hey, slow down a little bit, guys. Let's not make so many loans. Let's not make so many riskier loans, or let's make sure that there's enough down payment on this purchase. 5% is not a lot. What happens if they default? And, you know, so on and so forth. Maybe we should require a larger down payment. These are the sorts of things that people whose job it is to manage risk at these institutions and within these organizations, these are the things that they have to think about. The what if, you know, no one prepares for an apocalypse, but what happens if something goes sideways? And that's their job. And some of these institutions like Silicon Valley Bank that collapsed 2 weeks ago, or now pushing 3 weeks ago, they didn't have a risk management officer for like 9 or 10 months in place. That is a travesty. That is mismanagement at the highest levels. They didn't have someone sitting there at the bank going through the worst case scenarios in their head or on paper with their team saying, what if this happens? What if that happens? How do we protect ourselves? How do we protect our institution? They need to do that. And that's the responsible thing to do. That's the adult thing to do. And yet they didn't have that for like 9 or 10 months. And case in point, the bank collapsed. And we, the taxpayers, are bailing them out. So yeah, I'm not all that thrilled about that. But coming back to the mortgage world and the real estate stuff, what I anticipate we will see as we continue to go through this weird credit stuff and these weird banking things is for the adults in the room at these institutions to say, hey, we got to pull back on some of the more risky things that we've been flirting with, that we've been trying to do, because we're just not sure what's going to happen next. And until things calm down and stabilize, we want to stay with the vanilla, right? It's like when I was a young kid and I would get a stomach ache or be sick with something, God knows what I ate or whatever it is. My parents would tell me, eat white rice, right? Eat bland foods, eat stuff that's not going to upset your stomach. Don't have anything too spicy. Don't have anything too flavorful, so that things calm down internally until you get healthy again. And then you go back and eat your jalapenos or whatever it is. Well, same thing with the mortgage world. Same thing with the banking world right now. Until we get some kind of calming of what's coming next and a reduction of volatility in the markets, and the Fed and the Treasury do their job and actually calm the system down, I imagine that individual companies and institutions will be, in time, doing less and less spicy loans, because they want to make sure that their own health and their institutional health is intact. And that's what I predict. Now, I haven't seen a whole lot of that just yet, but hey, we're 2 or 3 weeks into the beginning of this, and we've got a long way to go. The markets are really volatile. Things are going up and down. The good news is the Fed is doing a job. I can't say if it's a good job or a bad job, but they're doing the job. And inflation is slowly coming down, and that's great. The bad news is, to every action, there's a reaction. And the reaction right now is what the Fed has been doing over the last year to combat inflation is having an impact on the banking system. It's causing companies to lay people off and to let people go. And there will be more of that as well. So buckle up. We're not out of this yet. However, I will tell you, it's still a really good time to buy a house. I know that sounds counterintuitive, but I have clients, bless their hearts, they're still struggling with multiple offers. As recently as today, I got a text message from one of my clients saying, hey, the offer that we wrote yesterday, we did not prevail. We got outbid. We're still seeing bidding wars. We're still seeing certain homes in certain neighborhoods and certain communities and certain markets like the Seattle market. We just don't have inventory. And so while everybody else is freaked out, if you can get in there and buy the house before everybody else starts coming back to the market, because eventually they will. At some point, people are going to say, okay, this is the new normal, and I still need that new house. Now's the time to do that. Now's the time before everybody else starts to think along those lines. Yes, it's scary. Yes, it's uncertain. Yes, it's unsettling. But if you have the fortitude for it, this is the opportunity to get some really good deals. So with that in mind, we're at 2:30. I can't believe how quickly time flies. I hope you guys have a fantastic day, a wonderful weekend upcoming. If you happen to be in the Seattle area, I don't know, bring a raincoat or something because it's messy out there. I will see you guys next Thursday. And in between now and then, please, don't be shy. Don't be a stranger. You know where to find me. Send me some notes. Send me some questions. Reach me. Call me if you've got anything that I can help you with. That's what I'm here for. I'd love to hear from you. Until then, be safe, be healthy, stay sane, and have a fantastic weekend. Y'all take care. Bye-bye.